The government has adopted a very pragmatic approach, keeping in view the larger socio-economic development objectives for the overall economy. There were different expectations from various stakeholders from the finance minister in this year's budget. Some of them have been met, and I think the remaining will be met in the years to come. Because of the various issues and constraints which the government faced in terms of fiscal deficit and balancing the expectations on infrastructure development, boost to investment in terms of industry and manufacturing, and providing concessions to the individuals, the government has done a very fine balancing act. From the corporate perspective, especially the foreign investors, they were looking at a tax regime which provides clarity and certainty, and I think the budget does very well on these points. One of the key concerns for foreign investors has been on the indirect transfer tax rules. There was a lot of uncertainty, especially in respect of the provisions as to what constitutes substantial value of assets located in India. The budget has indeed clarified that only 50% or more of the value of assets is situated in India, then the tax provisions will get triggered. Also, it has been clarified that only the proportionate value of assets as are situated in India would be subject to tax in India. Similarly, there are certain other important clarifications provided, and also a CBDT circular is expected to further iron out the issues on this count. Another issue has been of concern was on the anti-abuse provisions or the general anti-avoidance rules, in short GAR as we know that. Wherever globally the GAR has been introduced, a very soft touch has been adopted in order to make sure that both the tax administration and the taxpayers are very well prepared, and in what situations the GAR would be applied is very clear. Therefore, in the Indian context, the government has done a very commendable step by postponing the GAR by 2 years. I think it will provide sufficient time for the tax administration and the taxpayers to prepare for the new tax regime which is on the anvil under GAR provisions. The government has been stating its intent since the last year's budget that any changes in the tax regime will be with prospective effect, and I think in context of GAR provisions it augurs well when the government has clarified that only the new investment structures will fall within the purview of GAR, and all existing investment structures and transactions up to March 2017 will be outside the provisions of GAR. This is a very welcome move. Of late, there has been a concern whether MAT will be applicable on the foreign institutional investors. In fact, in the last year's budget itself, the government had clarified that the income earned by foreign institutional investors will be subject to tax under the head capital gains. Of late, various notices have been issued asking FIIs to clarify as to why MAT should not be applied to them. I think this year's budget has clearly clarified that MAT will not be applicable to FIIs. This will soothe the nerves of the foreign institutional investors, as there is no ambiguity left on this count. Also, certain issues in respect of the tax concessions earlier provided to real estate investment trusts have been provided for. I think it will also help the various investors which are planning to invest under the REITs trust route model. Thank you.